How compound interest makes you rich. Imagine two friends. One starts investing at age 20. The other starts at age 30. Both invest in the same fund. Both earn the same annual return. But after a few decades, the first person ends up with hundreds of thousands, or even millions, more. How is that possible? The answer is one of the most powerful forces in finance: compound interest. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. Whether or not he actually said it, the idea remains true. Compound interest has the power to turn small, consistent investments into life-changing wealth. In this video, you'll learn exactly how compound interest works, why time matters more than money, and how you can use this simple principle to become financially rich. Let's begin. What is compound interest? Most people think money grows because they keep adding more. But that's only part of the story. Compound interest means you earn interest not only on your original investment but also on the interest you've already earned. In simple words, your money starts making money. And then that money starts making even more money. This creates a snowball effect. At first, growth looks slow. But over time, it becomes incredibly powerful. Simple interest versus compound interest. Let's understand with an example. Suppose you invest $10,000. You earn 10% per year. With simple interest, every year, you earn only $1,000. After 20 years, you've earned $20,000 in interest. Your total becomes $30,000. Now let's see compound interest. Year 1, your $10,000 becomes $11,000. Year 2, you don't earn interest on $10,000. You earn interest on $11,000. Now your money becomes $12,100. Year 3, interest is calculated on $12,100. Your balance keeps growing faster every year. After 20 years, instead of $30,000, your investment grows to more than $67,000. Same investment, same return, huge difference. That's the magic of compounding. Why time is more important than money. Most people believe becoming rich requires a huge salary. But that's not true. The real secret is time. Imagine person A invests $300 every month starting at age 20. He stops investing completely at age 30. He invested for only 10 years. Person B starts investing $300 every month at age 30. But continues until age 60. He invested for 30 years. Surprisingly, person A can still end up with more money. Why? Because his investments had 10 extra years to compound. Time is the biggest multiplier. The earlier you start, the less money you actually need. The snowball effect. Think about rolling a tiny snowball down a snowy hill. At first, nothing exciting happens. The snowball remains small, but as it rolls, it collects more snow. It becomes bigger. Because it's bigger, it collects snow even faster. Eventually, it becomes enormous. Compound interest works exactly the same way. The beginning feels slow, but patience changes everything. Why most people quit too early? This is where many investors make a huge mistake. During the first few years, growth seems disappointing. You invest every month, but your account barely increases. People become impatient. They stop investing. What they don't realize is, most of the growth comes near the end. The first half of the journey builds the foundation. The second half creates the fortune. Compounding rewards patience, not speed. The power of monthly investing. You don't need millions. You don't even need thousands. Let's say you invest just $500 every month. If your investments grow around 10% annually, after 10 years, you could have around $100,000. After 20 years, around $380,000. After 30 years, nearly $1 million. Notice something, you didn't invest $1 million. Time and compounding created most of that wealth. Inflation matters too. Keeping cash under your mattress feels safe. But inflation silently steals its value. If prices rise every year, your money buys less and less. That's why investing matters. Your investments need to grow faster than inflation. Otherwise, even though your bank balance stays the same, your purchasing power keeps falling. The biggest enemies of compound interest. There are several mistakes that destroy compounding. First, starting late. Every year you delay costs you thousands in future wealth. Second, withdrawing money too often. Every withdrawal breaks the compounding cycle. Third, trying to get rich quickly. People chase risky investments. Many lose money instead. Slow and consistent investing usually wins. Fourth, giving up during market crashes. Market declines are temporary. Compounding works over decades, not weeks. How rich people use compound interest. Wealthy people understand one important rule. They let their money stay invested. Instead of spending every dollar, they buy assets, stocks, index funds, real estate, businesses. These assets generate returns. Those returns generate even more returns. Eventually, money works harder than they do. That's why many millionaires focus on investing rather than simply earning a higher salary. 5 steps to start today. Step 1. Start as early as possible. Even small amounts matter. Step 2. Invest consistently every month. Don't wait for the perfect time. Step 3. Reinvest all your earnings. Never interrupt compounding. Step 4. Stay invested for decades. Ignore short-term market noise. Step 5. Be patient. Real wealth takes time. Compound interest isn't magic, it's mathematics. But when combined with discipline, consistency, and patience, it can completely transform your financial future. You don't need to predict the market. You don't need to become a trading expert. You simply need to start. Invest regularly. Stay invested. Give your money enough time to grow. Years from now, your future self will thank you for making one simple decision today. Because the best day to start investing was years ago. The second best day is today. If you enjoyed this video and learned something valuable, make sure to like, subscribe, and share it with someone who wants to build long-term wealth. Thanks for watching, and I'll see you in the next video.